Have you ever wondered why, whenever a war breaks out or geopolitical tensions rise, the prices of gold and silver often fall at first? This seems strange because we've always been told that gold is the safest investment during times of crisis. If you looked at your portfolio this week and saw nothing but red, don't panic. Today, we're going beyond the headlines and diving into the real mechanics of the market. This is a pattern that has repeated itself many times over the past 50 years and is closely watched by some of the world's largest institutional investors. By the end of this video, you'll understand that this market reaction isn't driven by emotions, it's the result of a mechanical chain of events. Almost every major geopolitical crisis begins in a similar way. Whether it's conflict in the Middle East, the Russia-Ukraine war, or tensions involving major oil-producing regions, the first market reaction is usually seen in crude oil. Investors begin to fear that global oil supplies could be disrupted, causing crude oil prices to rise sharply. Oil is far more than just gasoline or diesel. Nearly every industry in the world depends on it in one way or another. From trucks and cargo ships to airplanes, factories, plastics, and fertilizers, oil is deeply connected to the global economy. As oil prices rise, transportation costs increase, manufacturing becomes more expensive, and eventually the prices of everyday goods begin to climb. Here's something important to understand: financial markets don't react to today's reality, they react to tomorrow's expectations. As soon as oil prices rise, traders, hedge funds, and institutional investors begin assuming that inflation will increase over the coming months. They don't wait for official inflation reports. Instead, they reposition their portfolios based on future expectations. That's why financial markets often move long before the actual economic data confirms what's happening. Stock markets become more volatile, bond markets react, and currency markets begin adjusting almost immediately. This naturally raises an important question: if inflation is expected to rise, what will the Federal Reserve do? The Federal Reserve's primary responsibility is to keep inflation under control. If inflation is already high, or expected to rise, it becomes difficult for the Fed to cut interest rates. Lowering rates too early could inject more money into the economy and make inflation even worse. As a result, investors begin to believe that interest rates will remain elevated for a longer period. And when interest rates stay high, another asset suddenly becomes much more attractive: U.S. government Treasury bonds. Think about it. If the world's most trusted government is offering annual returns of 4% or even higher with relatively low risk, many institutional investors naturally prefer moving a portion of their money into those bonds. This is where the pressure on gold and silver begins. Gold has always been considered an excellent store of value, but it doesn't generate interest, dividends, or regular income. If investors can earn attractive returns from government bonds while taking relatively little risk, it's only natural that some capital flows out of gold and into bonds. This explains why gold sometimes falls even during the early stages of a geopolitical crisis. Many people find this confusing because they expect gold to rise immediately whenever uncertainty increases. But the story doesn't end there. During periods of global uncertainty, investors don't just buy government bonds, they also rush toward the US dollar. The US dollar is widely regarded as the world's primary safe haven currency. As demand for dollars increases, the US dollar index, commonly known as the DXY, becomes stronger. Now remember one simple rule. Gold is priced internationally in US dollars. When the dollar strengthens, gold becomes more expensive for buyers using other currencies. As demand weakens, additional selling pressure develops in the gold market. So, higher Treasury yields on one side and a stronger US dollar on the other create a double headwind for both gold and silver. However, this pressure is rarely permanent. History shows us that every economic cycle eventually reverses. As inflation gradually begins to cool and economic growth starts slowing down, pressure builds on the Federal Reserve to lower interest rates. Once investors begin expecting rate cuts, Treasury yields start falling. As yields decline, government bonds become less attractive than before. At that point, institutional investors begin rotating their capital back into assets like gold and silver. If the dollar index also starts weakening during the same period, gold receives a powerful double boost. History has shown this pattern repeatedly. During several major economic cycles, including the aftermath of the 2008 global financial crisis and the economic recovery following the 2020 pandemic, gold experienced strong rallies after Treasury yields declined and the US dollar weakened. That's why making investment decisions based solely on 1 or 2 days of price movement is rarely a good strategy. Professional investors don't simply follow headlines, they follow macroeconomic indicators. If you want to better understand the future direction of gold and silver, keep your eyes on 2 key indicators. The first is the US dollar index, or DXY. The second is the US 10-year Treasury yield. If the dollar index begins trending lower while Treasury yields also decline, it can become a favorable environment for gold and silver. Instead of panicking every time markets turn red, focus on understanding the bigger macroeconomic picture. The investors who consistently succeed over the long term are usually the ones who understand the mechanics behind the headlines, not just the headlines themselves. If you enjoyed this deep financial analysis, don't forget to like the video, share your thoughts in the comment below, and subscribe to the channel for more in-depth content on the economy, investing, gold, silver, and global financial markets. If wars and geopolitical crises can initially push gold and silver lower, then why do these metals often reach new all-time highs months later? The answer lies in what happens after the panic phase. History shows that wars are incredibly expensive. Governments spend enormous amounts of money on military operations, weapons, humanitarian aid, and rebuilding damaged infrastructure. Most countries don't have enough cash sitting in reserve to pay for all of these expenses. Instead, they borrow money. This means government debt starts rising rapidly. As debt continues to increase, governments eventually face a difficult challenge. Paying high interest rates on trillions of dollars of debt becomes extremely expensive. Sooner or later, central banks come under pressure to reduce interest rates. And that's where everything begins to change. Lower interest rates reduce the returns available on government bonds. As bond yields decline, investors begin searching for alternative stores of value. Gold and silver suddenly become much more attractive. But that's only half the story. When central banks start cutting interest rates, the value of the US dollar often begins to weaken as well. Since gold is priced globally in US dollars, a weaker dollar usually creates a favorable environment for higher gold prices. This is one of the biggest reasons why gold has historically performed well after major crises rather than during the first few weeks of uncertainty. There is another powerful force that many retail investors ignore. Central banks themselves have become some of the largest buyers of gold. Over the past several years, countries around the world have steadily increased their gold reserves. Why? Because gold is one of the few assets that carries no counterparty risk. Unlike paper currencies, gold cannot be printed. Unlike government bonds, it doesn't depend on another country's promise to repay debt. During periods of rising global uncertainty, central banks often choose to diversify their reserves by buying more physical gold. This creates long-term demand that supports higher prices. Silver follows a slightly different path. Silver is both a precious metal and an industrial metal. It is widely used in solar panels, electric vehicles, electronics, medical equipment, and many advanced technologies. As the global economy recovers after a crisis, industrial demand for silver often increases alongside investment demand. This combination can sometimes allow silver to outperform gold during strong bull markets. That is why experienced investors don't simply react to daily price movements. Instead, they watch the broader macroeconomic cycle. The real question isn't whether gold falls for a few days. The real question is what central banks, bond yields, inflation, and the US dollar are likely to do over the next 6 to 12 months. Because that's where the next major move in gold and silver usually begins. In the next video, we'll discuss the biggest mistake that causes most investors to buy gold at the wrong time, and how professional investors position themselves before the next rally even starts.